Welcome back to Accounting Made Simple. I'm Agnieszka, and today we're diving into the balance sheet, a key financial statement that provides a clear snapshot of your business's financial health at a specific point in time. In this lesson, we'll break down the structure of the balance sheet and explain why it's essential for understanding what your business owns, what it owes, and what's left for its owners. The balance sheet, also sometimes called a statement of financial position, lists your business's assets, liabilities, and equity as of a specific date. It follows the basic accounting equation where assets equal liabilities plus equity. Assets represent what your business owns, such as cash, inventory, equipment, and property. Liabilities represent what your business owes, like loans, unpaid bills, and salaries owed to employees. Equity represents the owner's share in the business after all liabilities have been paid off. The balance sheet is called a snapshot because it shows your financial position at one specific moment in time, whether it's the end of the month, quarter, or a year. All right, let's break it down further, starting with the three main sections. First, we have assets, and these are divided into fixed assets and current assets. Fixed assets are sometimes also called non-current assets. And these would include things like property, equipment, investments, basically things that we hold for longer than 1 year. And our current assets will include cash and other assets like bank or accounts receivable, inventory, etc. And these are listed in a liquidity order. Similarly to assets, we have our liabilities, which are also divided into current and non-current liabilities. Our current liabilities are debts or obligations due within 12 months, such as accounts payable, taxes, and short-term loans. Our non-current liabilities are long-term obligations like long-term loans or bonds payable that aren't due within a year. And lastly, we have equity, which is also known as capital and reserves. And basically, this is what remains after subtracting all liabilities from assets and would include, for example, ordinary shares, preference shares, and retained earnings. So, why is the balance sheet important? Well, the balance sheet is essential for assessing your business's financial health and sustainability. And here's why. By reviewing the assets and liabilities, you can assess whether your business has enough resources to cover its obligations. For example, a company with more liabilities than assets may struggle to meet debt obligations. Moreover, investors and lenders often use the balance sheet to evaluate the financial strength of the business. They want to know if the company is financially stable before extending credit or investing. And lastly, comparing results of your balance sheet with different periods allows you to track the growth and changes in your company's financial position. Basically, we want to check if our assets are increasing or whether our liabilities are under control. If you want to dive deeper into analyzing financial statements, I recommend checking out our Small Business Accounting Essential course. In this course, we will guide you through using various financial ratios to better understand your financial statements. And if you want to check it out, I left the link below this video. All right, to sum it up, we have learned today that the balance sheet provides a clear, organized snapshot of your business's financial situation, helping you make informed decisions about managing assets and liabilities. In the next video, we will focus on how you can effectively collect outstanding payments from your clients. This may be a little bit outside of your comfort zone, but timely payment collection will positively impact your business and support a healthy cash flow. See you there.